Welcome to the Stock Market Palantir. Today we are going to talk about CETY.
Yes, CETY, Clean Energy Technologies, Inc. And we're diving into it because in late November 2025, it just delivered a real market spectacle.
It really did. The stock went absolutely parabolic. I mean, we saw a turnover ratio that went over 4,000% in a single trading session. And, that kind of movement, it forces you to ask a really crucial question about these microcap stocks.
What was really driving it?
Exactly. What was the true engine of that volatility? Was it, a market re-rating based on a legitimate high-growth fundamental catalyst? Or was it just the plumbing, the mechanics, the dark pools, these constraining structural factors? And I argue firmly for the former. For me, it was the primacy of the fundamental catalyst.
And see, I come at it from a completely different angle. While I agree, there's no doubt the company generated immense headline noise, I think the reality is that CETY's explosive movement was primarily governed by the underlying market mechanics. You have to look at the capital structure, the toxic financing, the fragmentation of liquidity. The mechanics didn't just facilitate the narrative, they completely dominated it. They just used the news as an opportunity.
My position is that this volatility was firmly anchored by, tangible business developments, things that signal a necessary and, frankly, a dramatic strategic pivot. This wasn't just speculative hype. This was the market reacting to demonstrated competence. CETY announced its largest contract to date, a $10 million battery energy storage system, a BESS project in New York, and this is a substantial 5-megawatt, 20-megawatt-hour deployment. This is the key. This one deal validates CETY as a real, bona fide engineering, procurement, and construction contractor, an EPC. Before this, they were a concept stock. And now they're a revenue-generating entity that can deliver complex projects in a sector that's in incredibly high demand. It's a material shift in their business reality. On top of that, the expansion into AI and crypto mining energy solutions, that provided that high-octane meme fuel you need for market ignition. They're leveraging their core waste heat recovery tech from microgrids through partners like True North Computation. They are addressing the critical energy bottleneck facing AI data centers. So the market recognized the immense long-term value of that AI and energy narrative, and when you combine that with a structurally tight 4.6 million share microfloat after the split, you just had the perfect scenario for ignition.
That's a compelling argument, and I agree. The BESS contract provides an excellent headline. But have you really considered the context surrounding the company's ability to capitalize on that news? The $10 million catalyst, while positive, I think it merely provided excellent cover for structural liquidity events that were, frankly, just inevitable. We can't ignore the company's weak foundation. I mean, a history of serial reverse stock splits, but the most recent one being that painful 1-for-15 in October 2025. These splits were done for one reason: to maintain NASDAQ compliance. That's a huge red flag that management just can't maintain value organically.
But they needed to stay listed to raise capital for growth.
And how did they raise that capital? That's the critical point. The structure is defined by its toxic financing. These convertible notes held by funds like Mast-Hill Fund, they convert at just deeply discounted floating rates, often 90% of the lowest volume weighted average price, or VWAP, over a certain period. This VWAP mechanism guarantees a perpetual dilution tsunami. Anytime the stock rallies, it doesn't represent intrinsic growth. It just acts as a guaranteed forced liquidity event for these debt holders. They convert their debt into shares at a massive discount, sell them immediately, and create this fixed destructive ceiling on the price.
What you're describing is a classic trading vehicle, where short-term volatility is engineered to facilitate long-term, devastating dilution. It's not built to be a long-term compounder.
Okay, and we can challenge the idea that this was organic price discovery by diving straight into the market microstructure data from that week. We saw off-exchange volume ratios consistently over 50%. This volume wasn't on the transparent national exchanges. And crucially, on November 17th, the FINRA short volume ratio for STETY was reported at a staggering 61.61%. This volume was not traditional bullish buying. It points heavily toward wholesaler internalization and institutional distribution. For listeners who might not track this stuff daily, wholesaler internalization just means that when retail investors placed market buy orders, their brokers routed them to large wholesalers, often in dark pools. And instead of finding shares, the wholesaler just takes the other side. They fill the retail order by shorting the stock. So the volume we saw in these dark pools was often smart money absorbing retail momentum and then hedging or selling right into it.
I see why you draw that conclusion from the data. The percentages are certainly alarming, I'll give you that. But let me offer a different perspective on that immense short volume. Look, dark pools exist, at least in part, to minimize market impact costs for big trades. The sheer velocity of trading, we're talking 144 million shares traded on a static 4.6 million float, that demonstrates massive, overwhelming, and urgent demand. And it was reacting specifically to the BESS contract news. So this required someone to step in and provide instant liquidity. The high shorting activity, in my view, simply reflects the mechanical reality of fulfilling this overwhelming surge of bullish retail market orders. The shorting was a consequence of the demand, necessitated by the tiny float. It wasn't the driver of price suppression. The price still went up because of the demand.
That's an interesting point, though. I would frame it very differently. While high demand does necessitate liquidity, the persistent high short volume in dark markets, where institutional players dominate, it suggests that the smart money was heavily positioning on the sell side. They were absorbing that retail buying momentum from your catalyst, yes, but they were doing so because they were certain the move was unsustainable. They were hedging against the inevitable mean reversion, and in doing so, they provided a massive synthetic supply of shares that ultimately dampened the full upward price discovery that your fundamental news might have otherwise created. The mechanism of shorting became the structural ceiling. It was capitalizing on the temporary excitement.
But the mechanical aspect of the squeeze is undeniable. It's the kinetic energy of this whole play. The 1-for-15 reverse split reduced the float to a critical 4.6 million shares. And yes, the turnover exceeding 4,000% created a purely mechanical micro-squeeze dynamic. But this structure required high-octane fuel to run. It absolutely required the strong AI and energy narrative, validated by that $10 million New York project, to initiate the belief and attract that intense speculative capital. The catalyst was the ignition fuel that set the already volatile mechanics in motion.
I'm sorry, but I just don't buy that the catalyst was the primary driver of belief. We need to look deeper into the supply side. The existence of high fails to deliver, or FTDs, suggests that the liquidity being provided was largely phantom. For listeners, FTDs just mean a market participant failed to deliver the security by the settlement date, often from uncovered short sales. This shows that market makers were relying on the high velocity of the rally to net out their positions, not on confirmed secured borrows. This churning action, selling shares they hadn't actually secured, is completely divorced from the company's operational progress or the validity of the BESS contract. And furthermore, if you analyze the retail commentary on sites like Wall Street Bets during that period, the interest was entirely mercenary. Their focus wasn't on the EPC validation. It was purely on the low float thesis, that magic number of 4.6 million shares, and the volatility potential that creates. They were chasing the momentum structure, not initiating buying based on fundamentals. The catalyst was just a convenient timing device.
But doesn't the success of the rally, even if it was short-lived and structure-driven, doesn't that validate the market's aggressive, opportunistic search for entries into genuinely high-growth sectors? CET's pivot provided the exact keyword density, AI, crypto, and battery that you need to trend globally. For a critical, 24 to 48-hour window, that potent narrative successfully overrode, or at least temporarily muted, the skepticism about their history of corporate governance issues like late SEC filings and NASDAQ deficiency notices. The narrative was powerful enough to temporarily override the perception of a poor structure.
We have to return to the structural gravity, because that story is constant, it's inescapable, and it is mathematically punitive. The mechanism of the toxic debt financing ensures that the narrative success you're describing is just translated into accelerated dilution. The constant supply of shares from agreements with funds like Mast Hill ensures that any price increase is immediately used for debt conversion. Remember the conversion mechanism, 90% of the lowest VWAP. If the stock hits $2 but then dips to $1 during that measurement period, the investor can convert their debt into shares at 90 cents. It's a massive immediate profit. This structure guarantees that rallies are leveraged to pay down debt by selling shares into the momentum. And we have filings confirming the November 3rd issuance of 100,000 shares to Mast-Hill to settle debt right before that spike. This inherent mechanism acts as a perpetual price ceiling and a devastating bull trap. The physics of the stock dictates that volume will be used to dilute, not to fundamentally re-rate the valuation.
Look, while the dilution risk is a severe, chronic headwind, and I'll concede the terms of those notes are predatory, management is attempting to use the capital they raised to fund tangible growth. They needed immediate working capital to transition into a new, higher-value business model. Securing that $10 million EPC role is a substantial, legitimate step toward potentially breaking that dilution cycle if they can successfully execute. The narrative in this context is the company's only lifeline to escape the mechanics.
The precarious regulatory status, however, just completely undermines this attempt at narrative salvation. They received a NASDAQ deficiency notice on November 5th, 2025, just 1 month after the reverse split, because the stock fell below the $1 minimum bid price. They also filed a Form NT10Q for late financial reporting shortly after. These operational failures dramatically increase the opacity premium. They confirm that the fundamental operational and structural health is poor, regardless of any single contract announcement. The structure punishes shareholders far more efficiently and reliably than the narrative ever rewards them. This stock is defined by its compliance hurdles, not its technical contracts.
So to summarize my position, CETY really represents a critical battleground where a high-value narrative centered on AI energy and validated EPC competence provided the necessary catalyst and momentum to get things started. The extreme volatility reflects genuine, massive speculative excitement in their strategic pivot, even if the execution risk is extremely high and the toxic structure makes the stock very difficult to hold. The fundamental shift was the reason the crowd showed up.
And I'll conclude by saying that the price action we saw is predominantly a mechanical function of market engineering and liquidity manipulation. The volatility is not indicative of sustainable value growth. It's a structural event used by market makers who exploited the tight float and toxic note holders who leveraged the VWAP conversion rates to capitalize on retail frenzy. To understand CETU, you have to prioritize the arithmetic of dilution and liquidity fragmentation over the hype of the narrative.
What the CETU story ultimately illuminates is just the profound divergence between potential fundamental valuation and the kinetic, often destructive power of market mechanics in this microcap world. It really demonstrates that sometimes the catalyst just provides the reason for the mechanics to engage with maximum efficiency.
Indeed, it demonstrates that structure often precedes and dictates the outcome, and there are many more complexities in the interplay between liquidity and fundamentals that we have to continue to explore within this material.
Thank you very much for hearing us. Let us know in the comments what is your opinion. And if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.